Good evening. Welcome to our educational webinar on self-directed retirement accounts and real estate investing. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm very glad to have you join me this evening. I am going to begin the webinar with just a little bit of disclosure information about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. We also don't represent or sell any securities or investments of any kind. We're not a registered investment advisor, and we don't represent or endorse any particular investment opportunities. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to start with some basic information about self-directed retirement accounts. I'm going to talk about the benefits that you have in self-directing, some of the guidelines that must be followed, some specifics about what STC offers, and then we're going to talk about choosing and funding investment and purchasing real estate particularly. And I will open the floor for your questions at the end of the webinar. So first, to get started, I do want to briefly define what we mean when we say self-directed retirement account. What we mean is that you hold an account with a company and a custodian who permit you to choose any type of asset that is allowed by law. Anything that is permitted by the IRS, the Department of Labor, ERISA, whoever is the controlling authority on the type of account that you have. So that would mean that you can choose things that some would consider non-traditional assets, like real estate. And we do have very many folks who come to open accounts with us who are particularly interested in real estate investing. Self-direction also means that you manage the investments that are in your account. You make the decisions that relate to those investments. So, for example, if you did own a real estate property, you would be the one who would decide if you were going to rent it and what the rental rates were going to be. You could determine who you wanted to rent to. You could decide if you were going to do any improvements to the property, and you can decide if and when you want to sell that property, what that selling price will be. So the bottom line is you really have control over these investments that you own in your retirement account. The self-directed industry has grown significantly over the last number of years. Many folks wanted to diversify out of strictly owning brokerage assets like stocks, bonds, and mutual funds. And we do find that a large portion of self-directed assets are in real estate types of investments. Now, there are a number of different types of retirement plans that can be self-directed. Remember, self-directed plan is not a type of plan. It simply means that you're holding with a company that permits self-direction. So you've probably heard of a traditional and a Roth IRA, individual retirement accounts or arrangements. I'll just mention a couple of things about these. Traditional and Roth accounts have identical contribution limits each year, and I believe they are the same this year as they were last year. Yes, they are. The contribution limits, you can contribute to both the traditional or a Roth IRA $5,500 of earned income for 2016 and 2017, and if you're 50 years or older, you can add an additional $1,000, so $6,500. The difference between these two types of accounts is that a Roth, unlike a traditional and other types of retirement accounts, Roth contributions are made post-tax. Other contributions are pre-tax. You don't pay tax on the contributions, but with a Roth, you do pay taxes on the contributions. But when you take qualified distributions after reaching retirement age, which is defined as 59.5, those distributions are not included in your taxable income. So Roth distributions are tax-free. So that is an advantage of a Roth account. There are other types of accounts, retirement plans. SEP is a simplified employee pension plan. A simple is a savings incentive match plan. These plans are often used by small business owners, sometimes sole proprietors or partnerships might have these types of plans. They allow you to make contributions from the earnings of your business, your company. So if you have a business, you might want to consider one of those types of plans. And now I'm also bringing out onto your screen 4 different types of plans that say former employer. A 401k is a for-profit corporate type plan. 403bs are usually used by charitable organizations or nonprofits. TSAs are tax-sheltered annuities. TSPs, thrift savings plans. If you formerly worked for an employer and participated in one of these types of plans and no longer work there, you should be eligible to move the monies out of that plan into a plan that you currently qualify for. Most likely a traditional IRA, but perhaps a business account, a business plan if you have a business. If you are currently employed and participating in one of those plans, you will need to check with your plan's administrator to determine if you are eligible to or allowed to move any monies out of that plan into a self-directed plan. That would be the deciding factor in the case of still being employed. Now, I want to talk briefly about the benefits of self-directing your retirement account or a portion of your retirement account. Probably the primary benefit that most people are looking for is to be able to truly diversify into different types of assets, including non-traditional assets, things other than stocks, bonds, mutual funds. So real estate certainly is an option. You can also invest in mortgages and notes. You can make loans from your retirement account. You could invest in a private business as well. The other benefit is you get to choose the investments and you control the investments. If you are looking at a real estate transaction, then you can increase the buying power of the monies in your retirement account by using leverage. And I'll talk a little bit more about that on a future slide. And because of all of these things, really being able to diversify into assets that don't directly correlate to the stock market, have the control that you have in making decisions that affect the value of your investments, and that possibility of using other people's money, you may be able to experience a higher return on your investments than you can in a non-self-directed account. Now, I said that I would talk a little bit more about leverage, and I do want to do that here since this webinar is focused more on real estate investing. You can increase your buying power and leverage or get a loan to buy a property in your retirement account. Now, it's actually your retirement account that is getting the loan, and it must be a non-recourse loan. I'll describe that a little more on the next slide, but first I want to give you an example. We have a client who purchased a property that she was rehabbing and then going to sell down the road. The purchase price of the property was $250,000. She used $125,000 cash from her retirement account, and she financed the remainder with a non-recourse loan. She paid $50,000 cash from her retirement account to a contractor to renovate that property. That renovation was complete and the property sold in 9 months, and she netted $100,000 on that property. So she had a gross return of 57% over that 9-month period, or a 76% annualized return. So using leverage might be something that you want to consider if you're interested in a real estate purchase. So let me just talk a little bit about what a non-recourse loan is. Non-recourse simply means that the lender only has recourse to the property that the loan is on in the event of a default. The lender cannot go to other assets in your retirement account. The lender cannot go to your personal assets. The only recourse the lender has is the property that the loan is on. So it's going to be more like a commercial loan as opposed to a personally guaranteed loan. Now, with a non-recourse loan, there's no income or employment verification because it's not a person getting the loan. It's your retirement account getting the loan, and so that doesn't come into play. Now, I'm going to walk through some industry standards. Of course, if you're interested in looking into non-recourse loans or a realty purchase, you'll want to go out and do some due diligence and check out some different companies and find out what their particulars are. What I'm going to tell you are just some general industry standards that generally apply in non-recourse lending. First off, as far as required documentation, of course, they're going to want a loan application, and they're going to want to see a purchase and sale contract for the property. They will want to see your IRA statement to verify, or whatever kind of retirement account you are using for the purchase. They want to see the funds in that account. They'll likely want an appraisal of the property, and if it's a rental, they'll want to see a rent roll of that property. As far as loan guidelines go, generally the maximum loan to value is going to be 70%. So you're going to have a much larger down payment required with a non-recourse loan. Maximum terms of the loan can vary from 20 to 30 years. Some companies do also do 3-1, 5-1, and 7-1 adjustable rate mortgages, so that is a possibility. What they generally are going to be looking for as far as income to expense ratio is 1.25% or higher. So they're going to look at the monies that the property is going to bring in compared to the expenditures. And lenders will generally ask for anywhere from 3 to 6 months of reserve expenses held in an account. And that's because the IRA is getting the loan, and the IRA must pay all of the expenses related to that loan. So the lender's going to want to be sure and see that the IRA has some reserve funds to cover unexpected expenses. Say you have to put in a new heater, you have to replace the stove. That money is going to need to come from the IRA. It can't come from you personally. Now, companies do lend on only certain properties. There are some ineligible properties. Eligible properties include single-family residences, some condos. Again, you'd need to check with a particular lender. Duplexes up to 4plexes, multifamily units, 5+ units, and retail, office, and warehouse properties. Those are eligible for non-recourse loans in most cases. Ineligible properties, mobile homes. I've never seen a lender lend on mobile homes. Timeshares, condo hotels, most restaurants, farms, residents that have 5 or more acres of property. Generally, most non-recourse lenders will not lend on those properties. So what you will want to do is just do some research into different companies and see what they require and what they compare to the property that you are looking at, possibly taking a loan out for. So those are non-recourse loans. Now I want to talk briefly about the guidelines related to your self-directing your retirement account. The same guidelines relate to all retirement accounts. Somebody has to fulfill the administrative requirements for the account. Every year an annual valuation must be done, an annual report sent to the IRS, Form 5498. Books and records have to be maintained of all your transactions. So all of your expenditures, all of your purchases, anything related to any of the investments in your account, earnings, tracking rental receipts, payments on a property, all of those must be tracked in detail. State filings may be required depending on what you own and where you own it. And tax returns can come into play in rare cases. Now I will mention that if you do a non-recourse loan, and I'm going to say this again later, tax return can be required. A non-recourse loan can trigger UDFI, unrelated debt financed income, which is taxable. I will mention here that STC is a full-service administrator, so we fulfill all of these administrative functions for your retirement account, except for the tax return. We are not allowed to do your tax return, but we would give you all the necessary documentation for your tax preparer if that came into play. Now, in addition to those administrative requirements, there are some guidelines that need to be followed. Again, all retirement accounts, not just self-directed, all retirement accounts have to follow these guidelines. And there are some assets that are prohibited, one being life insurance contracts. And I had someone ask me on a previous webinar if viatical settlements were allowed, and they are not. You cannot, that is a life insurance contract, and you cannot own that in a retirement account. In addition, collectibles are not permitted. Rugs, works of art, stamps, coins, wine collections, any of those kinds of assets are not permitted in a retirement account. Now, there are also some things that you must avoid doing in your retirement account. There are some prohibited transactions. Your retirement account is given tax preferential treatment, i.e. it's not taxed immediately, but only when you begin taking distributions, because it's meant to benefit you at retirement and not benefit you personally before retirement. So the transactions that you engage in your retirement account do need to be for the exclusive benefit of the account. You cannot personally borrow money from your retirement account. You also cannot pledge your retirement account assets to secure a personal loan. You cannot utilize your personal credit or your personal guarantee to obtain a loan for your retirement account. That's why that non-recourse loan requirement is in place. It must be a non-recourse loan. And you also cannot benefit any disqualified person by a transaction that your retirement account engages in. So let's take a look at who disqualified people are. And you'll see the first person I put up on your screen is you. So you and your retirement account are two separate entities, and your retirement account cannot do a direct transaction with you. And if you are married, that includes your spouse. So if you owned a piece of property, your retirement account cannot purchase it from you. That violates this rule and is a prohibited transaction. There are additionally certain family members who are disqualified from doing direct transactions with your retirement account. Ascendants. So that would mean your parents, your grandparents, your great-grandparents, on up the line. All of those people are disqualified. Your descendants are also disqualified. So that's children, grandchildren, great-grandchildren, on down the line. As far as they go, they are all disqualified. However, lateral family members are not disqualified. So that would include people like your siblings, your brothers and your sisters, your aunts and your uncles, your nieces and your nephews, your cousins. None of those people are disqualified to your retirement account. So if your father owned that property, your retirement could not purchase it from him. If your daughter owned it, your retirement account could not purchase it from her. If your sister owned it, your retirement account could purchase it from your sister. So just want to be aware of that as you're thinking about different assets that you might be interested in purchasing in. There are also a couple of entities that are disqualified persons to your retirement account. A company, if you own 50% or more of it, is disqualified. And a company, if you're an officer, director, or highly compensated employee. So there are some very specific guidelines for who disqualified persons are. They are laid out by the IRS in publication number 560, I believe. But anyway, you can also get that online from the IRS. But just to be aware, these are generally the main disqualified persons. Now, I mentioned just a couple of minutes ago that FTC is a full-service administrator, and I want to just run through what our approach is in working with our clients, and then we will get to investments and real estate investing in particular. With FTC, we set up a retirement account LLC structure for each client's account, and I'm going to tell you why we do that on the next slide. We have CPAs and attorneys to answer your technical questions. We offer unlimited guidance on transaction compliance. You can call our customer service department, client services department as much as you need to, as often as you need to make sure that your transactions are structured properly. We handle all the back office support of your account, all of those administrative functions. We maintain financial statements for your LLC so that you can actually see an income statement and a statement of cash flows for your retirement account and really be able to run it like a business. We supervise the regulatory reporting, and we oversee the annual valuation that must be done each year. So we really provide all of that back office support so that you can really focus your time and your efforts on finding the best investments for your retirement account. Now let me elaborate a little bit on the benefits of the LLC structure that we use. We do this because it offers maximum flexibility in structuring complex transactions. We have folks come to us who maybe want to do leverage, maybe they want to have a partnership with other sources of funds, and maybe that one of those other sources of fund is also going to have a loan. Maybe there's going to be a rehab going on, and one of the people is going to be the general contractor. So there can be very complex transactions, and using the LLC structure gives you a lot of flexibility in structuring those types of transactions. It does provide an additional layer of asset protection. It is a limited liability company, and it gives you checkbook control over your retirement account funds, which means you have immediate response to investment opportunities. We realize good investments can go very quickly, and you need to be able to move on them. Now you'll notice I have checkbook control in quotes, and that is by design because we do not give our clients the checkbook for their retirement account. And we do that purposefully. We do that to protect our clients from potentially engaging in a prohibited transaction. I didn't go into the penalties that relate to engaging in a prohibited transaction back when I was telling you about them, but there certainly are penalties. If you engage in something that is not allowed, the IRS can levy penalties up to forfeiting your entire retirement account. So we don't want to put our clients in that potentially precarious position. So what we do is we review your transaction, and we can if we get your documents by 2 p.m. Eastern Time, we can same day fund that transaction, or next business day if it's after 2 p.m., if everything is all lined up. So what you have is you have experts looking over your transaction and making sure that you comply with the IRS rules so you don't get yourself in trouble. So it's protected checkbook control. We really can fund very quickly for you, but you know that experts are looking over your transaction. Using the structure also simplifies asset titling. You will give your LLC its name, and all of the assets that you purchase through your retirement account owned LLC will be in the name of that asset. So it simplifies asset titling and transfer of title. And it does make it simple, straightforward to pool with other funding sources. Now let me just mention here that this is not a generic business LLC. Perhaps you've set up one of those, you do a business on the side and you run it through an LLC. That is not what this is. This is a very specialized LLC. Its articles of organization and its operating agreement are written so that they comply with the rules governing IRAs. So it is an LLC that is designed to be owned by a retirement account, and our experts set that up for each client's account. So that is the type of LLC it is. Let me just show you quickly a schematic of the structure of how that works. You'll see over on the upper left, you'll see your current custodian. If you decided you wanted to work with us, you would fill out documents, and one of those would be a direction to your current custodian telling them to transfer or roll over funds from your retirement account with them to our self-directed custodian. While that was happening, we would be creating the LLC, that special LLC, in the state that you choose. Once that is set up and the funds are received by our custodian, then another document is executed that directs our custodian to purchase all of the ownership of this LLC. So then all of your money moves to a bank account that your retirement account owned LLC has access to. And then you're ready to start that same day or next day investing. So here you see this particular account wholly owns 3 different investments. And that's how our generally our schematic for client setup works. Now in choosing an investment, there are very many options open to you when you have a self-directed account. And I've just brought out on your screen a bunch of real estate investments: single, multifamily homes, vacation property. Let me just mention a caveat here. You can own vacation property in your retirement account, but you can't personally use it. And neither can your ascendants or your descendants. Remember, they're prohibited. They're disqualified persons. So just keep that in mind. You can own vacation property and let your brother and sister use it, but you can't use it. Raw land, building lots, commercial buildings, real estate syndications, tax liens, all of those are permissible. You can also invest in mortgages and loans, private business investments, operating businesses, precious metals, the foreign currency market, options, futures, and of course stocks, bonds, and mutual funds. So quite a diverse range of different types of assets that you can hold in a self-directed retirement account. Now I want to talk about how investing your funds would work with STC. I recommend, and our Client Services Department recommends, that you request review of your transaction and the structure of it in advance before you're ready to actually invest, so that they can look over the documents and they can ask you any pertinent questions and make sure that your transaction complies with the rules and it can be same day or next day funded. So that is always available to you. Then we have we have a form. It's called a request to transfer funds. So it's a form that you would complete, and it has some, would require backup documents, especially if you're doing a real estate transaction. Then our Client Services Department reviews that transaction. So you fill out the form, you send any backup documentation, you can email that or fax that to our Client Services Department, and they immediately review your transaction, same day. And then if everything is good to go, they will process that transfer request, and the funds will be sent from the LLC bank account to the seller. And now your retirement account will own that investment. Now let's look specifically at purchasing real estate. You will need to locate the property and make an offer. So it is your responsibility to find the property. We don't provide any type of recommendations about whether or not it's a good investment. We don't offer any rental advice or any resale guidance. We're not permitted to do that. Now the offer that you make on the property must be in the name of the buyer, and in this case the buyer is your IRA LLC name. So let's say when you opened your account with us, you told us to set up an LLC in the state of Maryland, and you wanted it named Sunrise Investments LLC. Then when your retirement account is buying a property, that offer and that contract needs to say Sunrise Investments LLC, not your name. It needs to be in the name of your IRA LLC. If I haven't actually gone over this in detail yet, but if you are co-investing with another investor, let's say you have some personal investing money and your retirement account has money, and you are going to use those 2 pots of money to purchase something, then that offer and that contract needs to be in your personal name and your retirement account IRA LLC name. And whatever percentage ownership they are in, let's say it's 25% you personally and 75% your retirement account, that title needs to be 25% you personally and 75% your retirement account. I'll talk a little bit more about co-investing in a bit. Now, oftentimes you'll need an escrow deposit. And so in order to do that for you, we will need a copy of the contract showing your IRA LLC as the buyer and a completed request to transfer funds form. Those are the two documents. And then if you're going to closing, we do need a copy of the estimated HUD or settlement statement showing the IRA LLC as the buyer and that completed request to transfer funds. And we really would like that paperwork by 2 p.m. the day before closing. And that's 2 p.m. Eastern. We're actually located in Maryland, so Eastern time at the latest. It is best, client services loves this, it's best to provide additional time in case there is an issue. You know, we can't wire the funds out if the buyer's name isn't listed properly or if we have some questions. Sometimes some things that have happened is that a client has made a down payment from personal funds instead of from the retirement account funds. That's a problem. So that would be that disqualified person, you and your retirement account, and that's not allowed. So we really do appreciate the opportunity to review your transaction in advance. Now, oftentimes, the disbursement of the monies for the purchase need to be guaranteed funds. And so we can do a couple of different things. We can do a wire transfer, and we can also do a bank official check. So we just need to know which you like and how you want it delivered. Wire transfers are probably the quickest, but we can also do, we could FedEx or next day a check too. So there are different ways that you can get those funds, but you will need guaranteed funds. Now, one of the benefits of our IRA LLC and working with STC is that you, the client, can go to the closing. You can go to the settlement table and you can sign all the closing documents on behalf of your IRA LLC. And that's different from custodians who you have to send the closing documents to, and they sign on behalf of your retirement account. So what we want to discuss the transaction with you to make sure you're not dealing with any disqualified parties and that you're not using any prohibited funds and that you are using the proper name and titling, but we do not need to approve or sign the documents. So that is a big plus. You can actually go to closing. And then what you'll do is send a copy of those closing documents to FTC, and you can keep the originals, but we'll have a copy in your files. Now, I mentioned earlier non-recourse loan. You do have the option to use borrowed funds to make a purchase. Must be a non-recourse loan, and I mentioned earlier UDFI. That is a subset of UBIT, unrelated business income tax. UDFI, unrelated debt financed income. And this does come into play with the earnings on your property that you have leveraged as long as you had 12 months, up to 12 months after the loan is paid off, all the earnings. Now, I'm not going to go into detail on UDFI. I do have a previously recorded webinar on our website that I'd invite you to listen to, and I do cover it in some, I will cover it in some future webinars in detail. But you do want to do an evaluation. You don't want to simply discount the possibility of using leverage because there could be a tax consequence. Because oftentimes the earnings on that property are so significant that even though you have to pay taxes, it's still a very good investment. So something that you want to run by your tax accountant and really think about before you discount it. We certainly do have folks using leverage to purchase real estate property. So this is, I did want to spend a little bit of time talking about partnering with another source of funding to co-own a piece of property. You can do that. You can partner with anyone at the inception of a transaction, and that includes people who would otherwise be disqualified persons. Now, what that means is you have to partner with them at the inception. So let's say you are going to partner with, say, your wife's IRA funds, So your IRA and your wife's IRA are going to co-invest in a property. As long as you do that at the inception of the purchase transaction, that does not violate the disqualified person rule. Now, those ownership percentages can never change. So if, let's say, you funded 30% and your wife's IRA funded 70%, everything would have to be 30-70% from there on out. You could never change that. So all property expenses would need to be paid pro rata based on that ownership. All revenues would need to be distributed based on that pro rata ownership. That can never change if you've partnered with an otherwise disqualified party. Now you can also, and we do have some folks do this, set up a sub-LLC to own the property. So their retirement account owned LLC that we set up then purchases a sub-LLC that you set up. All the rules that relate to retirement accounts still must be followed. The reason that some clients prefer to do this is they want to hold a particular property in its own LLC. Now, how this would work is we would want to see the operating agreement for that sub-LLC because we need to see clearly who the owners are and what they're contributing and their percentage of ownership. And we will expect that those percentage of ownerships to match the amounts that are invested, and it's actually a requirement. If the owners are disqualified parties, it's required that they have to match. Now, there is a possibility that one of the parties could serve as a general contractor. And as long as they're not a disqualified person, then they could do that. And they could get a larger percentage of the profits for playing that role, for being the general contractor. But if any of the parties are a disqualified person, then you cannot do that. So when you're thinking about that kind of a transaction, you'll definitely want to talk to our client services department, and we can help you understand what is and is not permissible. Keep in mind that, even with that sub-LLC, all the same IRS and ERISA guidelines apply. You can't personally guarantee a loan. You still have to use a non-recourse loan. Even if you personally are partnering with your IRA, if you personally are getting your personal part, getting a loan on that, that too must be a non-recourse loan. You cannot personally guarantee a loan that has anything to do with your retirement account. So keep that in mind. Now, we sometimes have real estate agents who want to be the realtor for their retirement account real estate purchase, and we strongly discourage that. It can be very tricky. You don't want to involve yourself in a disqualified, prohibited transaction, so we really recommend that you don't do that. Disqualified persons cannot do any rehab or repairs on a property that your retirement account owns. So your brother could work on it, but you can't work on it. Your spouse can't work on it. Your son can't work on it. Also, they cannot be the tenant, the buyer, or the seller of that. So you want to keep those things in mind. Now, back to partnering with others. You can partner with yourself and with your spouse and with family members, including ascendants and descendants, as long as that partnership happens at the inception of the transaction. That's the only way it works. You can also invest with colleagues or other LLCs or investment syndications. So your retirement account does not have to wholly fund an investment. You can pool or partner with other funding sources. So let me show you a schematic where that has happened. You'll see the same setup that you saw before. Here I have labeled the investments. Investment number 1 is a tax lien. Investment number 2, purchase of property for rehab and rental. And investment number 3, here's where you pooled funds with others to purchase a small retail center. and you were all co-investors at the inception of the transaction. And here you'll see all three of these parties would otherwise be disqualified: your father, your daughter, and some of your personal money. But as long as you do this at the inception of the purchase transaction, then this will meet the rules, meet the requirements. And let me show you a quick pooling example, and then we're going to go to Q&A. This is an example. We had some folks I've rounded the numbers and changed everything, but you can see how a group of investors could co-invest. There was an apartment building. The purchase price was $2 million. They paid 100% cash for it, and that came from 10 people, $200,000 each. $100,000 from each person was retirement account money, and $100,000 was their own money. Obviously, these numbers are made up, but they weren't all exactly equal, but we'll pretend they were. What this group did is they formed a new business LLC that had 20 member owners. 10 were people, 10 were retirement accounts. Each member owned 5% of that LLC. The rents from the apartment building were paid into this business LLC, and the expenses of the apartment building were paid by that business LLC, and then the net earnings were distributed to their 20 owners, 10 people, 10 retirement accounts. So that kind of pooling investment certainly is permissible and can be done with a self-directed retirement account. Now we are going to take a little bit of time for Q&A right now, so I hope you have typed your questions in. I've just put up on your screen our website, stcira.com, our corporate office, and the way to get in touch with me, my email, and my phone. So I hope you will do get in touch if you need to. Let me just open up my question box. And let me look for the ones that I got in advance. Okay. Okay, the first question I have is, what is the time frame to get my account up and running with STC? Typically, it does take a bit of time for us to get it set up. We ask for 4 to 6 weeks. It doesn't usually take that long, but from the time your original paperwork reaches our office, we do have to coordinate the custodial transfer of the assets, get that money from your current custodian to ours and then to the bank account. So all that involves, plus we have to set up the LLC, and we have to work with each state to do that, so it's somewhat dependent on their LLC processing time. So we do ask for 4 to 6 weeks. So if you are already looking at investments, please do get your paperwork into us. We don't want to hold up any investment for you. Excuse me. Once we have the account set up, then we can do that same day or next business day for your investment. So it's just the initial setup that takes some time. Okay. Okay, my state has a high annual LLC fee. Can I use a different state? Yes, you can. You can use any state that you like. We do have a registered agent company that we can use to assign you a street address in the state that you'd like to establish your LLC in, if you don't have one of your own. There is an additional fee for the registered agent fee. It's a small fee. If you plan on purchasing real estate within your account, we generally do recommend that the LLC is set up in the state where you plan to purchase real estate. You can talk to our operations manager about that prior to the LLC setup, and talk with her about that, and she can, give you some ins and outs of do it here or do it there, and then you can make the decision on what you'd like to do. Okay, this is a question about a loan. Does STC choose the terms of my loan? No, we don't. This is truly self-direction, so you're going to choose the terms of your loans. What we will do is we will make you aware if the terms of the loan might raise a red flag in an IRS audit. So just to give you an example, if you're loaning funds for 5 years to somebody at 1% interest, that's going to look pretty fishy. So remember, your IRA's goal is to make money for your retirement. So the IRS would wonder why you were making that kind of a loan at such a low rate. And we wouldn't tell you to change that, but what we would tell you is that this might raise a red flag. And so you could be putting your IRA monies at risk. Oh, here's another loan question. Does a loan I make from my IRA have to be secured? No, it doesn't have to be. That's not a requirement. The IRS doesn't require that. We don't require that. However, most folks believe that your IRA's investment is more protected if it's secured. So you want to be sure that if you do have collateral listed in the note, in the loan documents, then that a lien is recorded on that property. That would be something that you would need to initiate. That is not something that we can do for you. You would do that on the behalf of your retirement account, put a lien on that property that your IRA is making the loan from. Okay, do I have to pay taxes on the income that is generated by my IRA? Generally, no. Tax revenues earned in a retirement account are tax deferred, meaning you don't pay taxes until you begin taking distributions. And if it's and then when you take distributions, the distributions are included in your income and taxable unless it's a Roth account. Now, let me just say though, if you use a non-recourse loan that we've talked about, then you may have to pay UDFI on the income based on the amount of leverage on that property. So you do want to keep that in mind and check out that webinar or get in touch with me and I can go over it with you too. Okay. Now this is kind of a tricky question and I don't think I can, I will say the question, but I don't know how long the answer would be. Can I purchase property that I use? Can I purchase property that I used to be part owner on if I sold it to my uncle or my cousin? And if so, how long must I wait to purchase it with my self-directed IRA? The IRS is going to look at that transaction and, you know, I don't know the answer to that, I'll have to say. How long, if it's a short period of time, then they would probably be of the opinion that you did that so that you could buy it from yourself. It wouldn't be an arm's length transaction. So that is a legal question, and I honestly cannot answer that one. We cannot provide templates for doing loans. I'm sorry, we are not able to do that, but I would imagine that you can find a loan template and then fill in those documents and call our client services department and have them look that over, and they can tell you if it meets the requirements or not, but we do not provide loan templates. What are the fees associated with an account? I would be happy to send you our client fee schedule. I will tell you that we do have an initial setup fee, and actually I will send you a client fee schedule so that you have it in writing. But we do have an initial setup fee that covers the cost of creating that retirement account owned LLC and all of the custodial transfer, etc. That initial setup fee is generally $2,000. That can be paid from the monies being transferred to us. Then we have just a wrapped management fee. It's less than 0.25% per quarter. So it's 0.245% per quarter. 0.245%, so less than 0.25%. And I will send that to, I can see who asked that question. What is the minimum amount required to open an account? To open a new account with us, I believe it's $300. But obviously you can transfer monies to us from an existing account. You don't have to open a new account. Okay, this is a very good question. Can you explain, if I buy a rental property, how would funds be distributed for rehab? Home Depot, contractors, dumpsters, etc. What happens is you work that out with our client services department, but you do not have a checkbook. So what you would be doing is you would be emailing or faxing us a copy of an invoice, and we would be writing that check to the vendor. And we do this for many clients, so we have a system in place that works well, but you will not be writing those checks yourself. You would let us know, and we would write those, and then we would have documentation of all of that for the books and records for your account that needs to be maintained. Can I make it part of my trust? Your trust can be a beneficiary of your retirement account. I cannot answer the question if you can make the retirement account part of your trust. That will be a question for your accountant. I do apologize. We're not permitted to answer legal or accounting questions. Can I make it? Okay. Let's see. I'm considering a Roth conversion. Okay, before I go to their question, let me just say what that is. Roth accounts, as I mentioned, Roth accounts distributions are tax-free. Some people who have traditional IRAs wish they had a Roth account so that the earnings could be growing tax-free. You can convert a traditional IRA to a Roth. That would be a Roth conversion. When you do that, there are tax consequences because monies that were contributed to a traditional IRA were contributed pre-tax, so no taxes were paid on those contributions. Money that goes into a Roth is post-tax. So if you are moving money from a traditional to a Roth, you will need to pay taxes on it. So that would be something, first off, you want to check with your accountant. Many people do it because they see the advantage of then the Roth earning tax-free. So this individual is considering a Roth conversion. Should I do that prior to transferring or rolling the funds over to you? And if so, are there additional fees associated with the conversion? It doesn't matter to us if you have it converted at your current custodian or if you move the money to us and we convert it. Makes no difference to us. I will tell you that we do not charge you anything to convert traditional to a Roth. You would need to check with your current custodian to see if they have a charge for converting. I'm looking at my time and I'm just about out of time. Let me see. I did have a question. If I can find it here. Oh, I answered that one. Okay. Can I divide retirement plans into several LLCs that properties may be in different states? So I will say that there is, we do have some clients who have one account but two LLCs, and they wanted to hold a certain asset in a certain LLC. So the answer is yes, that is possible, and you would talk with our client services department about exactly how to do that. And I do want to answer this one last question because it relates to rental property, and a lot of people listening to this webinar might be interested in owning and holding rental property. They want to know if a property manager is required. So what we would say is you're not required to have a property manager. We encourage it because it makes sure that there's an arm's length distance between you and the transactions related to your property, but it's not a requirement. You would need to understand, if you don't have a property manager, the extent of your role is very limited. You know, you can choose tenants, you can forward their checks and their money orders, you can choose appliance, but you can't like go buy the new stove and take it to the property and install it. That is not permitted because you are a disqualified party to your retirement account. You can hire somebody to do that. You can choose the general contractor. You can choose subcontractors. If you don't want to have a general, you can choose subcontractors, but you can't be at that property every day overseeing the work like a job, because you can't do that. So we really do recommend that you hire a general contractor for the rehab and that you have a property manager. That really makes sure that you avoid any difficulties. And if you are looking into that kind of a transaction, we would say, please call our client services department, and they'll talk with you about it. And we want you to be able to do everything and anything that is within the law, but we want to protect you from getting into any difficulties with your retirement funds and your investments. So that is all the time I have for tonight. If questions come to your mind after the fact, please do get in touch with me, email, call, check out our website. I do hope that you will join me for a future educational webinar. There will be one next month. It is the first Tuesday. I don't have that date in front of me, but I will be talking about a wide variety of different types of assets, not just real estate, some creative things that clients have done and some things that might help you consider options for yourself in your retirement account. Thank you so much. Please do let us know how we can help you. We would love to help you get started with self-directed retirement account investing. So just get in touch. Thanks, everyone. Good night.